Hey there, everyone. Happy Wednesday, September 10th, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, here on a beautiful, sunny, and cool summer afternoon in Redmond, Washington. Hope you guys are all doing well and staying safe wherever you're at. It's sort of an interesting day market-wise. Obviously, a pretty strong open after the PPI numbers came out before the open today. Long story short, the PPI number weaker than expected, right? Suggesting on the producer side, prices coming down a bit as opposed to inflation running rampant. This is good news for Fed watchers. Certainly suggests or implies that a 25 basis point rate cut is all but assumed for the September meeting. Market actually pricing in a low but possibility, a possibility of the Fed lowering by 50 basis points, which does not seem like a reasonable expectation. I think 25 basis points is pretty much going to be it. But we'll certainly be listening to expectations about further rate cuts for the remainder of the year. Two other possible rate cuts that we could see between now and year end. We're going to get to the charts. We're going to get to a lot of discussion here in a moment. Also had a interview yesterday for the podcast with Ian Reynolds. Ian is the director at Suberia Capital, former market maker, money markets and currency trader, and really good discussion about the Fed, about blockchain, because he was an early crypto investor, certainly an early Bitcoin investor, the dollar and dollar dominance in the world as a reserve currency. A lot of great sort of macro discussions that should be out for you. Hopefully tomorrow morning we'll get that out to all of you. With that in mind, let's look at the markets here and see how things played out here. So the S&P 500 up about 1/3%. So we're at 65.32. The NASDAQ composite flat for the day. The Dow 0.5% lower, 45,500, just slightly below that. Mid caps and small caps both slightly lower. So that stronger open that we saw really ended up not continuing higher. So it's interesting that after that initial open, we had sort of the market drifting lower. And I certainly, thought with the PPI number earlier today, thought perhaps, and certainly with the Oracle news yesterday, basically the stock getting absolutely popped to the upside on basically AI related news. Certainly expected a stronger day than we saw today. The breadth was actually kind of weak, as you're going to see from a moment. And the problem is names like Apple and Amazon actually went lower today. So, kind of mixed results, right? I mean, all is not well. This is not a everything obviously doing great kind of market. I think there's still quite a bit of a question mark hanging over the S&P and the NASDAQ. Enough intro. Let's keep talking about the charts. VIX slightly higher today, about 1/3 of a VIX point. We're still below 16, which means still a very low volatility environment. In terms of interest rates, you can see the 10-year Treasury yield, as well as the other points on the Treasury curve, moving lower. Bond prices, the TLT up 0.6%. The dollar essentially flat from yesterday. So that has been a trend we've been observing here over the last month or so, and certainly in September. Bonds are really starting to break out. So while stocks are sort of holding their gains and holding steady, bonds really starting to push higher. And this does, I think, relate to the inflation data we had today. Tomorrow we have the CPI, which is a little more widely followed. We'll see what numbers we come up with there. But overall, I mean, higher bond prices, lower bond yields certainly seems to be in line with this expectation of the Fed lowering rates and, all the signs there of a slowing economy, giving the Fed opportunity to lower rates and plenty of space without too much worry about shocking prices to the upside. At least that's the expectation here. Looking at precious metals, gold making another swing higher here, up about 1/3%. Silver prices up 2/3%. Crude oil prices actually moving higher. So most of the commodity space actually doing quite well. You're going to see that the energy sector was actually an incredibly strong mover today. Cryptocurrencies, we can see Bitcoin up about 2%. Bitcoin traded just briefly above 114,000, certainly, or currently trading just slightly below there. Ethereum price is up 0.2%. We're at 43.38 and change. So most of the top 10 cryptocurrencies tracked on the stock charts platform in the green today. Nice move higher there. Bitcoin obviously sort of in wait and see mode, right? Had a big move to new all-time highs around 125,000, pulling back. Now maybe bouncing off the support and rotating higher. That's sort of the general trend I'm observing there. We talked about that. I think last week we shared the chart of Bitcoin. It might have been earlier this week. It's a bit of a blur, but pulling back to an established support level and potentially rotating higher. Looking at the 11 S&P sectors, literally split between the two. Technology up 1.8%, energy up 1.8%, utilities up 1.7%. Utilities were more toward the top of the list earlier in the day, if I remember right, and they led yesterday, but technology ends up getting the top spot. Certainly, you've got Oracle, Broadcom having pretty strong up days, certainly helping the XLK move to the upside. On the downside, the two consumer sectors, consumer discretionary, XLY down 1.2%, consumer staples down 1%, healthcare down 0.9%. So the consumer space not doing particularly well. I mentioned Amazon, sort of breaking down. Amazon and Apple now two of the more, less optimal charts. Amazon kind of pulling back to a coil pattern. I did grab both of those charts to show you here in a few moments. Looking at the breadth conditions, not great today. Not horrible though, right? Small cap, you can see 60% down to 39% up, but the rest of the breadth data sort of neutral, right? I mean, but more negative neutral, right? S&P 500 60% down to 40% up. I might, if I'm stock charts, which I am not personally, but if I might share some feedback. This feels like more of a red day to me. I think the algorithm actually says anything below 40% it would be labeled bearish, but boy, 60% up to 40% down doesn't feel neutral to me. That feels more clearly bearish, but I guess that's more of a semantics thing. Having said that, breadth not great. And if you look at the chart of the advanced decline data, you can see it's not confirming new highs in August or September. I'll show you today the percent of stocks above their 50-day moving average actually went down today. So this is one of those days where a couple of big growth names having significant strong upswings, enough to make the S&P and the NASDAQ kind of look okay, while the average stock actually pulled back today. That's sort of the environment that we're in. The problem I have with that is that's often what happens at major tops, right? You have a lot of things starting to rotate lower, but enough big names still are strong that it holds the market, sort of keeps the indexes more elevated than you might expect. Broadcom, of course, having a significantly strong day. This is after earnings last week, the gap higher. Monday, Tuesday sessions sort of, maintaining that move. Today, actually breaking to a new 52-week high. I did grab that chart to show you here in a minute. NVIDIA, a strong day as well. Semiconductors generally having a pretty decent day today, up almost 4%. Microsoft actually bouncing higher. That's been one of the charts that's not been particularly good. I highlighted two of these names down over 3%, Apple and Amazon. Apple coming out of the product announcement that apparently was not well received as we look at it. Chart of the S&P, we're going to get to it in a minute, but I'm looking at a rising wedge here, to be honest with you. And I actually didn't highlight that on the chart, but I will I'll make a note to point that out here in a moment. All right, we're going to get to the market carpet, the heat map. And as a reminder, I can see questions coming in on the live stream. We're live streaming now on Facebook, LinkedIn, YouTube, and X. Appreciate all your questions coming in. And if you're watching the replay on our YouTube channel, just put a question in the comment section below. We'd love to hear from you. A lot of the comments that I'm seeing here, unfortunately, to take a moment about Charlie Kirk, which looks like he's a conservative commentator. Looks like he passed away. And this is not a political show, and I try desperately to stay away from news and other things. All I will say is if I feel like I'm stumbling on my words a little bit, I just saw the news and looked into it a little bit before we started here. I'm sickened by the whole thing. I hope you don't know too much about my own political leanings, because I try to not make any of my content about that. And regardless of what you think or what you believe or who you think is right or wrong, something like this just really sickens me. And that's all I'll say about that. Let's continue on here. Looking at the heat map. So, when you're looking at the heat map, obviously there's a number of things we can do for, on a visualization like this. We're looking at the high level, we're looking at the big picture, and we're seeing what's working and what's not. But we can also look more granular and understand some of the specific names and groups and themes that are on the move. This looks to me like a very mixed day, right? You can see some stocks that obviously had an incredibly strong day, particularly Nvidia, Broadcom, a lot of the other semiconductors. You see Arista, Micron, AMD having good days. Oracle, of course, the big gainer today with the news this week. But elsewhere, you'll see some green as well. Energy moving to the upside. Industrials, particularly some of the big industrials, some of the aerospace names. Raytheon, GE, diversified industrials like Eaton Corp up 4%. Howmet Aerospace, HWM. These are stocks that had pretty nice upswings. Some of these charts like Howmet, just to dig into it a little bit, had been struggling, right, since the end of July. If you look through August, you see a pullback to 170. And now we're actually starting to rotate back higher. So names like HWM, I would say kind of encouraging because we're back above the 50-day moving average. One of those basic things that I would look for in this kind of chart, particularly when we fail to hold support, right? It's sort of a classic bullish trend, higher highs, higher lows, pullbacks to a 21-day exponential moving average. That's kind of a classic bullish, uptrend kind of chart. When we start to pull back, we fail to hold the 21-day EMA, we fail to hold the 50-day moving average. This is where obviously the chances of us having a much more significant drawdown are very real, right? Now the uptrend is no longer in place. And I would say the fact that we're breaking below the 50-day, for me, one of the basic things you can do is just say, all right, show me when the stock is back above the 50-day, then I would consider it as a potential, new uptrend. And I think going back to off the April lows, right? Look how we rallied up to the 50-day. We finally gapped above it. We gap above that previous high from February. That's when it's really like an all clear, okay, we're back into an uptrend. And before you say, isn't that way too late? I mean, no, right? You have the opportunity to participate in the uptrend being sustained much, much further. And I think you're seeing that here in early September. Not that I can't, guarantee this sort of move here over the next, going into year end essentially. But I would say, a you are here moment, we're kind of right there. And what was encouraging back here in April, right? Think about what happened right around this point. If we are in a you are here, kind of indicator. So we got back above the 50-day moving average. We continued further. The RSI pushed above 60. We broke to a new high. And those were the things that sort of gave you all right, check mark, we're now in a primary uptrend. We've done one of those things, and that we've gotten back above the 50-day moving average, which means RSI pushes above 60. We break above 190, 192, which would sort of complete that upside rotation that we saw back there in early May. So, charts like Howmet, I think pretty encouraging. There's so many charts that feel very extended, right? Feel like they've had their run, and you're concerned about kind of getting in way too late. Charts like HWM feel earlier on, feel like they're just emerging after a significant pullback. So, in this sort of environment, looking for stocks breaking back above their 50-day moving average, kind of an interesting, group of stocks to look for. I'm jotting down HWM. I think that's a compelling rotation, and I think that's just representative of some of the charts that you see in the industrial sector. GEV is another one of those, right? Pulling back, now breaking to a new swing high, getting back above the 50-day. I think that's an encouraging development. I mean, boy, I'm not going to tell you energy is a super bullish sector just yet. There are random names, but I think you have to look for them. Like Apache is probably interesting. I'm trying to think of names that are actually breaking out. I was looking Baker Hughes, maybe BKR. I might have grabbed this chart already, but charts like this breaking above a recent swing high, I think those are bullish charts. That for me is a Dave Keller thumbs up bullish kind of setup. A lot of these other ones are still very underwater, right? I mean, the chart of ConocoPhillips is not a bullish chart at this moment, in my opinion, right? We're back below the 200-day. We had a nice upswing, but this is not a stock that's really demonstrated its ability to trade above the 200-day and maintain those gains. So I'm much more, into stocks that are actually showing that buying power is overwhelming that selling pressure. ConocoPhillips and a lot of the other energy names, just still not great charts from a technical perspective. So I personally would be looking for those that are demonstrating that they're decent charts in any environment. I think that's it at a high level here. I mean, boy, lack of participation today in communication services, not horrible, but Alphabet, Meta, Netflix, and then some of the big telecom names, AT&T, T-Mobile, Verizon, all down today. Healthcare, which has been an emerging area of strength, not showing a lot of strength today, sort of pulling back here. And consumer, I mean, just absolutely nowhere to be found. You have Amazon down pretty big in consumer staples. You have plenty of the big box retailers pulling back and failing to follow through. A lot of these, maybe stalling out today. Too early to say these are breakdown charts, but I mean, I'm more drawn, I guess, to today to things that did not participate in the uptrend versus the ones that actually did surprise to the upside. Shout out though, one last one, Blackstone. I meant to grab this and I didn't. So I'll highlight this classic bull flag pattern. All right, bull flag pattern is a well-documented chart price pattern in the technical analysis toolkit. You have a big run higher. You have this parallel channel of higher. We're in an uptrend, and then we have lower highs and lower lows. The buy signal, kind of traditional buy signal using this methodology, is when we break above the upper boundary. The way that you know it's a bull flag pattern, by the way, or one of the easy kind of litmus tests, draw the upper trend line first. So I'm kind of drawing it here. I'm connecting kind of that first peak, connecting it with some of the other peaks, then do a parallel line. So on stock charts on a Mac, you hold the command key down and click on the first one. It creates a parallel line. A lot of charting platforms, at least the good ones, have a way to do that. They're all different, so I can't give you the ways on each of those platforms. If you don't know, reach out to them, their customer service. Hopefully they can tell you how to do it. But drawing a parallel line, and then you can see how well that lines up to the recent lows. So lower lows, lower highs, that's a bull flag. And it's called that because you have this big uptrend. That's the flagpole. This is the flag. The buy signal, the general way that you interpret this is the length of the flagpole. You should have a parallel move on the way up, which basically suggests Blackstone going a lot higher from here, according, if that is a bull flag pattern that was just confirmed, which it seems to. So what else would you use to kind of confirm this? Well, on a bull flag pattern, you can always look at the beginning of the flag, which is around 180. So if you're super conservative on a chart like this, break above 180 on stronger momentum, ideally stronger volume, would validate that uptrend phase. But I would say for me, Blackstone looks like a pretty positive move with that bull flag pattern continuing. All right, let's finish off looking at some charts. Again, I do see some comments and questions coming in on our live stream platforms. We're live streaming on Facebook, LinkedIn, YouTube, and X. Thank you, honestly, so much. Those of you tuning in live, I appreciate it. If tuning in live is not your thing, or it's not good because of your time zone or whatever, I can handle it. If you can, you can always watch our shows on our YouTube channel. Questions are always welcome. Just put a comment below the video with your question. We got some great questions so far this week. Already grabbing a couple for our all mailbag episode on Friday. We'd love to answer one of your questions as well. So please keep them coming. All right, looking at the charts today. So the S&P, I mean, again, is there anything that's not good on this chart? Maybe one or two things that I'll tell you here in a minute. But overall, I mean, obviously the simple fact that we're making higher highs and higher lows is bullish. Now to avoid gumming up my beautiful daily S&P chart with other stuff, I'm going to go to just a really basic chart here on the S&P to show you what I would say is a pretty classic rising wedge pattern, you call it. So a rising wedge happens in an uptrend. I feel like this is chart pattern day, just kind of how it's happening. This is what a rising wedge kind of looks like, right? So you're in an uptrend, and the uptrend's continuing. So you're still making higher highs and higher lows, but it's basically a narrowing of the range, right? You see how this is not a parallel channel, but it looks like it's kind of narrowing in, right? Higher highs and higher lows, but it looks like it's going to hit a point down the road here. That's called a rising wedge. Usually is interpreted as being a bearish pattern, and often because what happens is, I mean, the way I would think of it is, you have a big run higher, and look at how the pace of the advance has slowed down. We had another one of these, by the way, back here, right? You can call this a rising wedge as well, right? Where, not an exaggerated one, but I remember thinking about this. All right, this is a potential rising wedge. So what you have to remember is at this point, it is a potential rising wedge. It is not a rising wedge pattern. This is where I think a lot of people run into trouble. If you see what's happening here and you say this is a rising wedge, it's bearish, you're missing on some of the key parts of pattern analysis that Edwards and McGee, who wrote kind of the Bible of chart patterns in the mid 20th century, John Murphy, Martin Pring, Charlie Kirkpatrick, people that wrote sort of these classic technical analysis books. You're missing the most important part of these patterns, and that's the trigger, right? These patterns actually have three parts. You have a setup, which is it looks like the pattern. That's where we're at here. There's the trigger, which is we break the point, which confirms that it's a valid pattern. Then we have the confirmation, which is some sort of follow through. So at this point, we've only had one of those three things. You can look back here in June to see we had a similar sort of phenomenon. Looks kind of like a rising wedge. So I would say, yeah, we've done the setup, which is it looks like it. The trigger is you break below the lower trend line, and that's super important, right? Patterns like this, flag patterns, head and shoulders patterns, cup and handle patterns, they all have the same idea. Three parts: the setup, the trigger, and the confirmation. So the setup is it looks like a rising wedge. You see this narrowing of the range. The trigger is we break below the lower trend line. The confirmation is you have at least further move to the downside, telling you it wasn't just a one-day thing. So right now, similar to what we saw back in June, it's done a setup, right? It looks like it might be a rising wedge. It's not a rising wedge, or at least a confirmed rising wedge pattern, until we do those other two things, which means we have to break below this lower trend line, and then we'd have to follow through at least some further movement in that direction. So at this point, am I super concerned by a rising wedge? I'm not. Because unless you have the breakdown, it's not a rising wedge, which means S&P goes below 6,400. I think that's a pretty concerning, reality that rising wedge pattern is confirmed for now. Just something we're watching. I'm going to save that chart so I can have more thoughts about it. But that's kind of how you can interpret what's happened in the last 4 to 6 weeks. Potential rising wedge pattern. Dave Keller, official terminology, says it's not a confirmed rising wedge yet. You need a breakdown below that lower trend line to validate it. So that's one thing, is a potential rising wedge. What else concerns me? The weakening momentum, right? We just keep making new highs on weaker momentum readings. Today is no different. We've made a new all-time high today with the RSI around 63. The new all-time high in late July, the RSI was around 75, 76. So we keep making new highs on weaker momentum. That's not great. The way that we negate those negative bearish kind of red flags and have a all clear, things are great, all is good uptrend is we don't break down through the lower end of that rising wedge pattern, and we break higher on stronger momentum. We need momentum and volume injected into this market. Right now, it's more of a languishing uptrend. It's kind of tripping higher, and not really moving higher in a resounding way. Other things that concern me, here's the S&P making a new all-time high today. Worth noting that the percent of stocks above their 50-day moving average, which is at the bottom in green, the percent of stocks above their 200-day moving average, which is here in blue, both went down today. So the S&P is making a new all-time high, and on that same day, stocks are breaking below their moving averages. Now, it's not everything, right? It's still over half of stocks above their 50-day. Breaking below the pink line here at 50% would be a negative sign. We haven't seen that in quite some time. And I think very importantly, in late July, the indicator held that 50% level. That's something I might be looking for here. But keep in mind that the fact that the market's moving higher on weaker breadth is just not great. Is it bad? I mean, it's not bad, right? And that's where, indicators are bad when they break below kind of the bullish ranges. When the S&P itself starts to rotate lower, that's where you can say, all right, the chart of the S&P really looks bad right here. It doesn't look bad. I mean, it's giving the early warning system or early warning signs that haven't been followed through just yet. All right, that was enough kind of deep dive on the S&P and breadth. Let's finish off looking at some individual stocks. We'll take a question or two, and we'll wrap it here for the afternoon. By the way, shout out to my good friends and fellow Stock Charts contributors, Julius de Kempener, founder of RRG Research, Tom Bowley, founder of Earnings Beats. They're both in town here in Redmond, so I'm going to meet up with them after the show to hang out a bit and say hello. So shout out to my friends and Stock Charts contributors, Tom Boley, Julius DeKempener. All right, Broadcom making new all-time highs with authority today. We highlighted, on Monday and Tuesday's show, kind of a lack of follow-through, right? You had the gap higher on earnings here on Friday, Monday and Tuesday, kind of remaining within that range and not really getting the follow-through. But boy, today really, we got the follow-through, right? And I think one of two things happen when you have a gap that's stalled out. We start filling that gap, and I think that's really concerning because that tells you, boy, no buyers coming in. Boy, today buyers really came in, and that's the positive resolution to that pattern. I think Broadcom back to a pretty bullish chart at this point. Oracle, I'm looking at the weekly chart. It's obviously up significantly today after the news yesterday. The weekly chart of Oracle, I think, is the story here, right? And that's, I'm reminded when I'm doing, shows with Grace and Rose. We did last week the top 10 charts to watch for September. Check that one out, by the way. That's on the Stock Charts TV YouTube channel. We posted that last week. Great discussion about a lot of different charts, but we often bring up the weekly charts, looking at longer term trends. And that's, I think, the story of Oracle, right? It's not the fact that we're up 20, 30, 40% in a day or in a week. All of that's good. I think it's the weekly chart that tells you the long-term story of charts like Oracle, right? This is one of those core holding types of names that's had an incredible long-term run. I think that's, today's gap higher, just the latest move within a long-term secular uptrend for a consistent winner. Boy, Apple and Amazon are two of the Magnificent Seven charts I would argue that probably look the least encouraging right now. I don't own Apple directly, but if I did, I would be concerned. Not end of the world, I need to liquidate kind of concerned, but more, this is a chart I need to watch closely and I need to clearly define my risk. And this is where I think people get into trouble. Don't wait for Apple to be down at 200 to write in during the show and say, hey, what do I do now? I own Apple and it's down this much. Think now, right? And the analogy I always use for this is, as a student pilot, you spend a ton of time going through emergency situations. And one of the things I learned from learning to fly a Cessna 172R is you don't wait for the engine to cut out to figure out what you're going to do in that situation. You got it all laid out ahead of time, right? So when you're flying straight and level at 6,000 feet, everything's good. There's no traffic. You kind of know where you're at, where you need to go. Everything's making sense. That's when you're thinking about a disaster scenario. That's when I think, okay, over there is an airport I could land at, or an abandoned Air Force base where, the runway's still good and it's on the map. I bet I could get it. All right, what frequency would I need to use in an emergency? You have all of that ready. So if something happens, you don't have to sort of go into, okay, now what do I do? You already know what you're going to do. So when something bad happens, you just go to the emergency checklist and you start following those steps. This is the mindset I think more investors need to have, right? If Apple's a holding, it's down a couple days, define your risk now, right? Where's that level where you start cutting that position or start trimming that position? Don't wait for the stock to be down 5, 10, 20% to think about what you're going to do about it. Think about it now when the stock's just down a couple percent and it's just down a couple days and it's still holding a recent low. For me, I'm always looking to the left, that 225, 224 level. That's the swing low from late August. The 200-day moving average, the 50-day are all around 220, 221. These are, key levels I would probably keep in mind that if we would start to break those, that's where if I did have a position, that's where I probably start to trim a little bit because it tells you, it doesn't say we're going to go down to 170, but we're definitely heading in that direction. And so I probably want to be a little more cautious, but think now on that initial drop. And again, I'm identifying some key levels based on support, based on the moving averages. Those are some of the levels I would pay attention to. Amazon took kind of a rough turn today, and the down move takes it back within a symmetrical triangle or coil pattern. A coil pattern is where you have a narrowing of the range, lower highs, higher lows, right? So an uptrend, higher highs and higher lows, a downtrend, lower lows and lower highs, a sideways trend, a symmetrical triangle or coil pattern exists when you have lower highs and higher lows. Now, the way that you get out of that pattern, pretty straightforward. Either we break above the upper trend line or break below the lower trend line. It actually resolved to the upside last week, which is why we highlighted Amazon as a pretty decent breakout. And the question was, can we get above that late July high? And we actually did that earlier this week. And yesterday made a new 3-month high. But today, dropping back down over 3%, and unfortunately getting back into the range of that coil pattern. So I think the breakout that we saw, in question, unless we can bounce off of that tomorrow. So I think tomorrow's session is going to be vital. If we can bounce off and this trend line becomes support, that's one of the more bullish setups we could probably get. But Amazon, definitely a red flag being waved right about now. GE Aerospace, just want to finish off with a couple industrial stocks, in primary uptrends. Aerospace defense names looking pretty decent. Not all of them, but some of them. GE Aerospace is one that I will highlight. If there's anything that concerns me, it's, again, similar to other charts that we've seen, a lot of the new highs in August and September met by weaker RSI readings, and I don't think that's great. However, it's above the upward sloping moving averages. The moving averages are in the proper order, as we say, with price above the 21-day, which is above the 50-day, which is above the 200-day. That's a bullish chart until proven otherwise. Finally, Eaton Corp, Northeast Ohio. Shout out to the where I grew up, and Eaton Corp with a nice bounce higher today. Closing above the 50-day moving average. We broke down below the 50-day back here in August. As we mentioned with an earlier chart, when that kind of pattern emerges, I think getting back above the 50-day, I'm kind of happy ignoring a chart like this until and unless we can get it back above the 50-day. Look at some previous times where that happened. Just in the end of last or beginning of this year, we obviously broke below the 200-day, the 50-day. We're in a clear downtrend. That break back above the 50-day is sort of your signal that, all right, maybe there's enough accumulation that we're starting to have meaningful gains. And I think getting back above key moving averages, RSI pushing above 60, these are all signs of a stock back in a primary uptrend. And if you haven't been in this stock by then, that's sort of your friendly reminder that this thing's really starting to work. You probably don't want to miss it. Maybe we're right at the beginning that here yet again. If Eaton can hold the 50-day, if the RSI pushes above 60, might be a really compelling setup there as well. I'm jotting that one down for the ticker list. All right. A number of comments here, a number of questions, and I appreciate it. Two questions on some. I don't want to get rid of that on some individual stocks. One is, where's it here? I can use this one. One on NVIDIA. Question was basically, what's going on in NVIDIA? Ruben, thank you so much for watching on YouTube, my friend, live. You often throw some great questions in here, and you said the NVIDIA chart is confusing to me. Can you explain it? I'll do my best. And here I'll tell you what I have. So the way I look at this, I have this chart list called the Magnificent Seven and Friends. These are like leading mega cap growth stocks that I want to follow, and I kind of want to always have a good opinion on. This is a strategy I started years ago. I don't save charts of all S&P 500 names. There's random charts that I get asked about. I kind of analyze the chart and move on. But this basket of stocks, I kind of always want to have an active perspective on what's happening here. So I created a chart list, and that, any platform allows you to do this. Good ones do. Having a list of charts, or at least having charts where you can save your annotations. I used to do this on Bloomberg with kind of the key Dow names that I was following, and certainly the S&P and gold and things like that. Having charts that you can always go back to and just keep updating your perspective based on how the chart's evolving, I'm a huge fan. So what's going on with the chart of NVIDIA? So, I guess it depends, right? It depends on your time frame here. The way that I'm thinking of it, if you look at, the general complexity, we have the move off of the April lows around 86 on an adjusted basis up to a peak around 185. And that really happened in late July, retested in early and mid-August, and now we've rotated lower. So for me, I think this is sort of in question mark land. And we highlighted NVIDIA as it broke below the 50-day moving average. As you probably picked up, that's one of those signs to me that something's not right, because healthy charts and healthy uptrends don't break their 50-day moving average. This tells you something's going on. So we broke the 21-day EMA. That's often my initial stop. We broke below the 50-day, which tells me probably get out of the way and wait to see how things emerge. Now, it's not a confirmed downtrend. Like, what would be a downtrend kind of chart? I think you have to get below like 140, 145, which would take us below the first Fibonacci support level, take us below the 200-day. That's when that looks like a clear bearish chart. I look at an energy chart. Most of them have spent a lot of time below their 200-day moving average. This is more of a not great, but still okay kind of chart, right? We're below the 50-day, but we're still above the 200-day. It's kind of mid-range, kind of backing and filling. The question is how we exit. So as we mentioned with some of the earlier charts, I think regaining the 50-day is pretty encouraging. Holding that would be super vital. With a chart like this that's stalled out, I wait for a break above that previous resistance level. So I have an alert set for NVIDIA above 185. I think that's where it becomes a clear bullish chart again. Until then, it's more sideways, right? It's more choppy, sloppy sideways. You can draw a big rectangle over the last 8 weeks or so, and that pretty much describes the price action with NVIDIA. It's not a downtrend. It's not an uptrend. It's a sideways trend. So wait for the price to break out of that range, and I think you're in good shape. Chris, thanks for this question. I almost want to save this for the mailbag, and I might give them a deeper answer elsewhere. But how do you diversify by strategy? Trend following, value, dividend, income. 100% I do. I generally describe. And thanks, Chris, for watching on YouTube, by the way. My general approach is trend following. So my primary approach is following trends. And that's why a lot of the charts that I highlight, it's charts like this that are breaking out, right? I'm not trying to buy at the April low when Blackstone is absolutely beaten down. That's not my general approach, which is sort of a deep value approach. I like to buy charts that are breaking out, right? Breaking above resistance in good established uptrends. My interview recently on the podcast with Larry Tentarelli, we talked a lot about trend following because he's a trend follower as well. That discussion will give you sort of a lot of good examples and just insights as to why that strategy works. It's called the momentum factor, and it works pretty well on a medium-term time frame. I do some value investing, and it's more longer term, right? If you look at the history of the equity markets, certainly secular time frame. Anytime you have big downturns like 2002, like the COVID low, like April of 2025, the market has recovered from 100% of its corrections over time. So buying in a long-term approach when things are really beaten down is something that has worked very well for me. So buying Bitcoin when it was getting absolutely crushed is something that I did. That has been probably one of my better trades in my career, was just buying GBTC when Bitcoin was completely beaten down. So I do some of that, and I do that in longer term accounts, and that served me well. I use a dividend strategy in some of my accounts as well. So buying, things that I own in that sort of space. I'm running out of chart screens that I want to use. Here we go. Like PFFA is an ETF that I've used before. There's an ETF that owns a lot of preferreds, and for me, that's been a decent income strategy, right? Decent income, decent dividend yield, AT&T kind of names. Those are things that I own as well. But again, my primary strategy is as a trend follower. One of the things I learned from my time at Fidelity was the benefits of diversifying by strategy, right? I mean, if all you do is momentum investing, it's going to work pretty well until it doesn't. And one of the things that I learned as part of being a good asset allocator is you have to allocate to different things. And two general ways that I think of this. One is diversify your technical approach. So while I'm looking for breakouts, I'm often randomly putting things into beaten down spaces. And it's sort of is this going to go to zero or is it going to find support? And I don't want to think too much about the timing aspect. I just want to buy something that's undervalued. I do a little of that. I want to buy things that have a decent dividend yield. That may not be my favorite charts, but they pay a good, consistent dividend. PFFA is one of those. Sometimes this chart's been an absolute dog, but it's had a pretty good, consistent return on the income side, and that's been helpful. So that's sort of a diversification by strategy. Also want to think about diversifying by asset class. So things that have a low correlation to stocks. Gold is probably the best example of that. One of the great benefits of gold is not just the fact that it keeps going up, which it does. It's the fact that its return profile tends to be very different from stocks. Sometimes they move together. Sometimes they move inversely. But again, if your entire portfolio is basically one bet, it's going to work until it doesn't. And when it doesn't work, you get absolutely crushed and you feel like an absolute disaster because you're giving back all of those great gains that you had on the left side. So, diversifying by strategy, diversifying by asset class are two things that have served me quite well. I might give a longer answer in some video that I put on some platform, but for now, I'll consider that to be my answer, and I'm sticking to it. Folks, thanks so much for tuning in on the show. Thanks for asking questions. Those of you that are doing it live, it's a pleasure to do the show. and see your comments and interact with you as we go. Please come back tomorrow. We'll do it. We'll do it again, same time, same place. In the meantime, thanks for watching. Be well, stay safe, and remember, it's always a good time to own good charts. Have a good night, folks.